What caused this rapid change in sentiments? The CSI 300 has jumped 22.5%, a 70 billion funding scheme, a massive 283 billion stimulus, property prices falling with as low as 40%, the risk still remains. In the recent weeks, the China stock market has seen a dramatic turnaround. After a period of sharp declines, optimism has surged in, followed by volatility. China's CSI 300 index, which consists of the large companies of Shanghai and Shenzhen, has nearly rallied a 35% in just early 10 days of October. But this optimism didn't last for quite a long. On October 9, the market dropped by a 7%, which was the largest one-day fall since 2020. The Chinese stocks even outperformed the Indian stock markets over the past 1 month. What caused this rapid change in sentiments for the Chinese investors and even for the foreign investors? So in this video, we will break it down, what the Chinese government is doing, what exactly has happened, and what this means for the investors, especially in India. So now on September 24, the China Central Bank and the financial regulators announced aggressive measures to stimulate the economy. These included the interest rate cuts, lower mortgage down payments, and easing the lending restrictions to boost the stock market investments. These actions came 3 years after the declining property values that had hurt the consumer confidence. By then, the CSI 300 lost half of its value and Hong Kong's Hang Seng had nearly dropped by 50%. However, no new stimulus has been announced after the October 10 news conference. So now, let's speak about China's new financial stimulus. On October 12, China's central bank has launched a 70 billion funding scheme to ease the liquidity pressures. Financial institutions can now use bonds, ETF, and the CSI 300 holdings as collaterals for liquid assets. This move is now designed to encourage investments into the stock market. China's finance minister has announced a massive 283 billion stimulus of sovereign bonds to support the low-income households, recapitalize the state bank, and restabilize the property market. China's retail investors flocked onto the online platforms like the Snowball and the Tiger brokers, both international and domestic investors rushing to buy in. The Shanghai Shenzhen CSI 300 and the Shanghai Composite have nearly seen a 2-year high. In just 1 month, the CSI 300 has jumped 22.5%, while the Hang Seng has jumped a 23.5%. But despite the initial excitement, we've already seen the pullback of CSI 300, correcting 7% in a single day on October 9, which is the largest single day fall since the 2020. This rally has been largely driven by the sentiments of investors reacting to the shift in the government policy towards growth. So the question is, can the rally continue? The answer depends on whether the government can deliver comprehensive economic support. We also see that there are deeper problems to China's economy. Let's talk about the real estate and consumer confidence dip, with property prices falling with as low as 40% in some areas. Despite the recent stock market gains, the corporate earnings outlook in China still remains weak. According to the recent data, wages in the Chinese cities have seen a drop year over year, further dampening the consumer spendings, contributing to the deflationary pressure. Coming next to the iron ore and the copper prices. The stimulus market have overall impacted the global commodity markets. Iron ore prices briefly hit a 2-month high, which is almost raised by a 3%. Copper, another key commodity, has seen a modest gain of 0.2%, reflecting the uncertainty in the China's economic performance. So, is there still opportunity in India? In October, the foreign investors withdrew a 5 billion from the Indian equities, leading to a drop of 3% from the benchmark index. This is the largest outflow since the March 2020 concerning India's high stock valuation. While the global investors are moving out, the domestic investors are now stepping in. In September alone, the Indian retail investors have poured in a 245 billion in the mutual funds via SIPs, setting a new record. This steady domestic inflow is helping us offset the impact of the foreign outflows, making the Indian market very strong. Some foreign investors are now shifting their focus to China, where the valuations are much lower and the stocks are much cheaper. While China China's market might look more appealing because of the lower valuation, the risk still remains. China is still facing significant economic challenges, while the many investors are still waiting for a clear sign of recovery before diving in. For now, India continues to offer more stable growth prospects. So, why do you think that India's growth will continue? It's because of the domestic consumption, young force, increasing investments in the infrastructure and technology. For investors, India remains a strong bet for the future. Even with the higher valuation, the long-term potential growth is very clear. The corrections that we are seeing in the recent week could present a buying opportunity for many investors. It could be a good opportunity to take an exposure in the Indian equities, buying the large cap stocks within the financials, consumer discretionaries and the industrials. So, are you bullish on the Indian growth story? If you enjoyed this video, make sure to check out our other videos on the stock market investing and more. Finally, do not forget to hit on the like, subscribe and tap on the notification bell for more insights. See you next time. Happy investing!
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.